I'm Charlotte McLeod with investingnews.com, and here today with me is Gareth Soloway, Chief Market Strategist at verifiedinvesting.com. Thank you so much for joining me. Always great to have you here.
Yeah, thank you so much for having me, Charlotte. Great to be here.
Of course, it's been a little while since our last conversation. We have a lot to catch up on. And where I thought we could begin with is just your general take on what's going on in the US economy. So, we've been talking for quite some time about the possibility of a recession and the need for caution when it comes to the stock market. And yet, year to date, we have indexes like the S&P and the Nasdaq up. So, can you tell me what is going on there?
Yeah, absolutely. So I think there's this divergence between what we're being told in terms of some of the stats and what really the underlying economy is showing us from like the perspective of a retail investor or just someone in the population. And what I mean by that is that you have data that is starting to show weakness, but the jobs numbers are still strong, but people are getting hurt because of inflation, because of other factors. And so you're still seeing this kind of chase for return in the stock market, but for the most part, people are now beginning, at least according to me, they're starting to be seen as kind of troubled. Like they're starting to experience the pain of running out of savings from COVID. And you mentioned the Nasdaq's outperformance, and I think a great stat here is that if you look at what the Nasdaq 100 is up, I think 36% year to date. If you take out the top five stocks, the Amazons, the Nvidias, the Microsofts, the Apples, and so forth, the Nasdaq would only be up about 13% on the year. So it's very much concentrated, contrary to what a lot of people will tell you. And that is, to me, a warning sign for the overall market as well, that it's so concentrated in a couple names.
Okay, very helpful explanation there. And I think connected to this, we do have all these calls for a soft landing getting louder and louder. Although, of course, I speak to many people who don't think that's the case. In your view, is there any possibility that that could happen?
I mean, there's always a tiny possibility, but I would rank it as a very slim one. The key here is, and this is really interesting, is if you go back to 2000 before the dot-com bubble burst, and once it started to burst, we saw the exact same thing. Everyone started calling for a soft landing. Everything was going to be okay. The same thing occurred in 2007, just before the financial recession. And so this is a very common thing where initially people expect something dramatic. Everyone's hearing, we saw the inversion of the yield curve and everyone immediately thought recession. But interestingly enough, with the inversion of the yield curve, the recession doesn't occur until the uninversion. All right, but people expect it as soon as they hear the headlines of, oh, we have an inverted yield curve. And so past recessions have proven this. And again, we're in that same situation where initially at the start of 2023, everyone was saying, wow, this is going to be a horrible first half. It turned out to be a great first half. Now no one is thinking it's going to be horrible, and that's usually when the bad stuff comes. So I do think the second half is going to be rough into 2024. And I think, remember, the Fed has hiked rates so much. This is the most aggressive hiking they have ever done in the history of the Federal Reserve. And there's a lag effect. There's a 6 to 12 month lag. And so you can't say that what we're experiencing right now is exactly where interest rates are. You have to give it about 6 to 12 months from now. And then you can say, okay, this is the economy under 5.25% to 5.5% Fed funds rate.
Yeah, I think that was a good point. People see things happen and they expect things to result instantly. We have that instant gratification mindset in so many aspects. So you mentioning yields, and I want to talk about the 10-year yield, I believe recently at a 16-year high. And you were mentioning on Twitter, that's another thing that can take people away from stocks, right, and into safety. So that was an interesting point, and I wondered if there is anything else you would highlight about that.
Yeah, so this is one of the really interesting things about the market that we currently are experiencing is that the higher interest rates go, the more people say, hey, listen, I can get 5% in a treasury. Why am I risking my money in the stock market when I could get a guaranteed 5%? So in the stock market, you can make 10, 15, 20%, but you can also lose 10, 15, or 20%. So in theory, the higher yields go, the more money it should suck out of the stock market as people go for the safety and the guarantee. The interesting thing is, in the current market, we actually have bonds being hated and people more interested in stocks. And that's a divergence that eventually will have to correct as well once people start to get scared. So, I mean, you look at things like the VIX being so low, the yields being as high as they are, all of these factors, there's this disjointed situation. eventually that all has to correct and you'll see the market come in and people will flock into bonds.
All right. And you started to talk about what's going on with the Fed, which definitely we have to talk about that. It's the Jackson Hole meeting this week. We are currently looking forward to Powell's speech on Friday morning. We do hope to post this interview before then. So I'm curious to know what you're going to be watching for when he speaks, keeping in mind that in the past, he's done a pretty good job of projecting what they're going to be doing.
Yeah. So in this situation, there's a couple things I'm watching. One is the Nvidia earnings that are just about to come out. They'll be out obviously by the time this interview gets published. But if they blow it out of the water and the stock market has a big rally, I wouldn't be surprised if it pushes the Fed to be more hawkish in Jerome Powell's speech on Friday. And the thought process behind that is if the stock market rallies significantly, the wealth effect propels investors to spend more money, which then creates potentially inflationary situations. So the other way could also happen if we see a big drop in the markets, the Fed may be a little bit more dovish on Friday. Based on what we're seeing from Fed funds expectations, the Fed is now not expected to cut rates until mid 2024. However, the question, and we'll find this out on Friday, is does Jerome Powell guide us to expecting another rate cut, another rate hike this year, or just continued pause? And I really think they're probably on the fence. The minutes from last week were very hawkish, but I do think, again, they're starting to see the breaks that I'm seeing in the data. For instance, I just heard this morning that jobs numbers are going to be revised down 300,000, I think 310,000 from non-farm payrolls. And so that really wipes out the gains of the last month. And that has to be something that we start to pay attention to.
Right. So that'll be definitely very interesting to see and watch what may be happening with rates. We're always laser focused on that. And I want to touch on inflation as well, because you have kind of warned us in the past. It's going to get sticky around that 3% level. And I'm sure that adds another element into what the Fed is planning there. So any updated thoughts on what you see there?
Yeah, so I think with interest rates, again, you're right. I've talked about the 3% level. Getting from 9 to 3 is the easier part. Getting from 3 to 2 is like, that's half of the battle, if not more than half the battle. And it's going to be tough because you have a lot of underlying things that are going to keep pressure on inflation. So I think the Fed will be forced to kind of hold out from cutting rates as long as possible. But my expectations are that the economy weakens so much in 2024 that they actually are forced to cut anyways, even with an elevated inflation number of around 3%. And I think you're starting to hear people talk about this where it's going to be the new normal, right? The new normal is 3%. We're going to say, okay, that's okay. We just have to make sure the economy doesn't go into depression. So I think you should expect us to start hearing that 3% from the government is okay, and that likely the Fed will be able to cut when that does happen.
All right. So, it's always so important to go over what's happening in the US. But this week in particular, we've started to see these headlines surface about big concerns in China. So, I know you have quite a global perspective in your research. So, what are you seeing there? To what extent should we be worried about what's happening in China?
Yeah, it's an interesting situation in China because, they didn't get the same bounce from when the lockdowns kind of, ended there versus what the US saw. The US saw this massive spending spree after all this money had been saved. In China, we didn't see that. And I think the key here is that their economy has been kind of teetering for a long time, and they've been plugging holes. Their real estate situation has been really bad for really the last 10 years, with whole cities in China being built up with no one living in them. So I think there's the bigger issues there of how they're going to get through this. I would say this is that China can potentially be harmful to the global economy, but I also think that the global economy has been diversifying their supply chains, their imports away from China because of the risk of Taiwan and what's going on there. So I do think China plays a big role. They're the second biggest economy in the world, but I also think that it's not as big a role as it was maybe 2 or 3 years ago in its impact on the global economy.
So these are really big issues we're going over at the country level in terms of the US and China. I do like to always relate these things back to what can individual investors or traders do. So do you see tradable opportunities in these circumstances?
Yeah, I always do, right? So for instance, for me, when I see China in tough situations, it likely means that there'll be more money printing to kind of maintain control, to get the population to be happy and to be okay with the government. And so I think, for instance, a small position, something like KWEB, which is the China ETF, is semi interesting at this point, based on where things currently are. Again, I'm all about buying the fear and then selling into the greed. And I think as a trader, that serves you very, very well if you look historically at the tops and bottoms of markets, stocks, and so forth. So I think that's an interesting side of things. I also think that there's some intrigue in the gold chart, right? So, in fact, let me bring up my charts here so we can take a look. Gold's having a big move today. And the key with gold, and here I'm just bringing up the chart now, but when we look at the gold chart here, there we go. We can see that gold is actually in this bullish consolidation wedge pattern here and actually having a pretty powerful move up. And so what I like about gold is we've seen such a strong dollar move to the upside, yet gold is still performing relatively well. And to me, that's telling me there's liquidity moving into gold as a protective asset. So I'm expecting us to start a bigger move up here that eventually takes out this triple top up here around this 2075 level. And I think that's a great, interesting area to play, potentially gold miners. Gold miners have been hit very, very hard here as well. They're getting a big bounce today, but you can see they're quite a bit off of their highs here of just really 6 months ago or so. So there are opportunities out there. I think people just have to be very choosy. And this is a market where you can't close your eyes and throw a dart at a dartboard and expect to make money like in 2021 or earlier this year. You have to be a little bit more, kind of a stock picker at this point.
Right. And I think you totally anticipated where I want to go, which is over to gold and look at where the price may be going for the rest of 2023. I know we talked before about moving past the all-time high, maybe even getting as high as 2,300 in 2023. So I wonder how that's looking for you. You mentioned we're in this consolidation right now.
Yeah, absolutely. So I think, again, at least, gold certainly hasn't been flashy this year. Last year was a much better performer in terms of its upside, outperforming the stock market and Bitcoin. In this situation, it's been more quiet, right? You haven't really seen a lot of price action. If you go to the beginning of 2023, I think we're slightly positive on the year on gold, but it's not been the amount of upside that we've seen in Bitcoin or in the stock market. But I will say this, in terms of risk versus reward, I think it's still a top play here for an investor. So you want to be in something where you're not going to see 20%, 30% drawdown versus, maybe you're not going to get 50% upside in a year either, but you can still see 20% on gold to the upside. And so I do anticipate by year end, there's this triple top here. Interesting little tidbit on education is that double tops get your big pullback. So here was your high, here was your double top, that was your big pullback. Historically, here's your triple top. You get small pullbacks and then breakouts. And so, again, that's kind of the game plan that we're following at this point, where I expect it to start to move up and eventually take out the highs. And I think, again, if you look at the fear of what could happen globally, de-dollarization, the fears of everything else in the economy going, gold becomes a pure play for safety, which can propel it much, much higher.
And, for gold, is 1900 the where it has support at the moment? Because I know we went a little bit below last week or so and then kind of came back up to rest there.
Yeah, that's exactly what it is. So again, if we just look at this trend line, it's really an amazing trend line. If you look at the top going back to March of 2022, and then you connect it to the secondary pivot here in February of 2023, notice how we broke out above it, retraced to that same exact line, bounced, and then retraced again. So this downsloping trend line is really the one I'm watching, which is the support line. And eventually this one should be broken and it should start to make its way back to the all-time highs. So really cool when it comes to charting to see how these lines, amazing to think that a line perfectly aligns with highs and lows going back to 2022 on this chart.
Okay, yeah, really interesting to look at the charts with you. And, I did reach out to our audience before this interview to see if anyone had any questions for you. And one of the requests was if we could take a closer look at the charts for GDX and GDXJ. So I wondered if we could do that and see what you are finding there.
Yeah, absolutely. So let's take a look here. Let me bring my charts back up and we'll dive into those, because I agree. If you're a gold bug, then the miners make total sense, especially if inflation starts to get kind of lowballed in that 3% range. The miners really underperformed over the last 12 to 18 months because inflation was so high, they couldn't keep up with the costs. The rising costs really hurt them. But I will say this, is if we just look at this chart, right? So here we have gold miners recently pulling back. And if we zoom out, there's a trend line up here. This is kind of your target, I would say, by year end for around the 38 marker, which is actually a pretty big move. It's a little over 33 bit, about 35% move to the upside. On the downside, the one thing you don't want to see happen is you don't want to see this area break. All right. So you wouldn't want to see the miners get below 24. All right. This trend line right here, right around 24 and a half. But again, right now, this is what's creating a bigger wedge pattern. And eventually you either test one of these sides and break one way or the other. My guess is if gold does what I think, it's going to be to the upside. And then if we look at GDXJ here, which is the miners, the junior miners, much the same. I have an old trend line there. I'll erase here for now, but we can see that same sort of trend line here where, again, you now have this point of interest here, which is right here as well. So there's a lot of support right around this 32 to 33 level. That's what you want to see hold. And then on the other side, you have a downsloping trend line here where you want to see this eventually get tested and break out to the upside. So a breakout really occurs above 40, and you don't want to see price break really 32 to the downside.
All right. Appreciate the detail there on those charts. Thank you very much. And in addition to gold, of course, we want to touch on silver. And I remember the last time we talked, you were feeling less optimistic about silver because of its industrial side. So I imagine that is much the same, but I did want to check in on what you see happening with silver in 2023.
Yeah, so I would say in general, silver I've been a little wrong on because I thought the economy would weaken sooner than it has. And I think the outperformance relative, in fact, you can see what a strong move silver has had here just from the last few days. The market is still very much in this, there's going to be no landing or it's going to be a soft landing. And if that's the case, then silver does very, very well. I don't buy into that narrative. I think that the landing is going to be a hard landing with the economy starting to sputter. So I ultimately kind of would still fade the silver move for now in the near term. Eventually, it becomes a big breakout candidate as the inflation kind of bites and stays stagnant around 3%. But right now, silver's had a great move. If you're watching silver, you can see we're at resistance here at $24.35. Wouldn't shock me to see a pullback off of that. But what you're looking for on the silver side, there's two trend lines. You want to see a breakout above 24.75 and then a breakout above 25.65. The 25.65 is the ultimate one. If you can break above that, you start to be able to test this $30 level on silver. And it's a wedge pattern again. These wedge patterns, they've been forming for a long time. And you want to see that high get tested for a potential, mega move to the upside.
Okay, very helpful because I know a lot of us are looking for that move to $30 for silver finally at long last. So we'll keep an eye on that. So I want to check in also on uranium, which is a favorite topic for our audience. And I believe in one of your recent videos, you're talking about liking the look of the URNM chart. So I wanted to check in there. It's an area where I think people have a lot of hope of how it's going to perform. The fundamentals are looking very positive, but we have been waiting for quite a while for that big move.
Yeah. So I continue to like this chart. It's already had a pretty big move on the breakout, but what you can see is here's another wedge pattern. This one actually has broken out though. And it's actually just in the last few days, it has had a monster move to the upside. Short term, it's starting to come into a little minor resistance around 38 and a half. However, I still think this is a bigger breakout on uranium that on pullbacks you look to buy. So again, I don't know how much it would pull back off of there, maybe just a minor amount. If you're a long-term investor, I think you just hold and let this thing continue up. But ultimately, this is a great sharp pattern breakout, and I think it does have significant upside. And the thought process here, and you always want to kind of look at the charts, but then what's the macro? And I continue to kind of come back with, you think we're having one of the hottest years or the hottest year ever on record. I mean, we've seen temperatures here in the US go kind of crazy, and there's going to be more and more pressure to figure out alternate methods of energy versus, solar and wind and these other ones, because we just can't produce enough at this point. We're still stuck on oil. And one of the outcomes of this is to look towards nuclear power, which could really generate massive amounts of energy. And I think if we're ever going to make any sort of change in terms of the climate, you have to go towards nuclear. And I think people are starting to realize that.
Yeah, I think definitely, at least in our audience here, you're definitely preaching to the choir on that one. So exciting to watch that happen. So I'm going to go back to my list of viewer questions here. I had somebody ask if you could mention any particular commodities related stocks that you are trading and what your time horizon might look. So I don't know how much detail you can go into there, but I wanted to throw it out there.
Sure, absolutely. I mean, so one position that I like right now is Newmont Mining. NEM is the symbol on this one. And what I love about it is you have this convergence of these two trend lines. And look at this beautiful one where it touches this high here to here to here, and then you broke out above it. And then you've just kind of been bouncing off this line the whole way down. And so ultimately, I think this starts to get a bigger move up, but buying right in this vicinity makes a lot of technical sense. There's just so much major support here. So the concept here would be that at some point, not only does it go up off of this line, but eventually you break through this line as well. And that's where you get the bigger move to the upside where it could trade back to 55 or greater. But that would be one of them that I like. I don't have a lot of other specific commodity ones at this point. I'm not a big fan of the oil stocks at this point. They've had such crazy runs to the upside. If you take a look at MPC, Marathon Petroleum, this one has just, you can see the channel. It's a beautiful channel, two parallel lines. We just hit the higher end of this. So I think that's pretty much made its run. There might be a little bit more back upside, but for the most part, I think the gold and silver plays are probably where you want to be, more so the golds. I will throw this out there. I am eyeing, and I'm not in this at this point, but something like Alcoa, as it comes down and gets lower, there is a lot of support around, I would say around 25 or so. And I would definitely be eyeing that as maybe a potential trade off of that level.
Okay, interesting. Interesting to have you go over that. And, it is always helpful to know what you are less interested in as well. I think that's good to look at. So we'll finish up on commodities here. We also, of course, have to check in on Bitcoin. And during that previous conversation that we had, we were talking about that 30,500 level. And I believe you had said if we get through that, that would be really big. If it didn't, then there was room to go all the way back down to 12,000, 13,000. So what are your updated thoughts on where Bitcoin is headed?
Yeah, and what we can see here is that on the Bitcoin chart here, we tested that area right here, same area right over here, and eventually it failed and came back in. And then we had this upsloping trend line here, which again, it's a trend line, meaning trend. And if you just connect all of these lows, that gave you that trend line. We've broken that. So we are getting a little bounce today along with gold. So that's interesting to see. But unless we recapture this area and then take out this 30 and a half, 31,000 area, to be honest, I would remain very careful on Bitcoin. I think overall the trend is going to continue down, more so not because of anything to do with Bitcoin. And I think for Bitcoin maxis, this is the hardest thing to understand, is that Bitcoin to me is a genius thing. It makes so much sense in every which way, but it still conforms to the laws of risk assets until it becomes a non-risk asset. And that means that if I'm right and the stock market has 20% downside from here in the next 6 to 12 months, it's going to be hard for Bitcoin to withstand that sell pressure in the overall markets. And that's to me where it could come down. The next level's at 25. Then we have major support at 20 and then ultimately back to 15.7. So I'm still in the camp that until we see the stock market really flush out, Bitcoin will remain vulnerable until that point or until the Fed starts printing aggressively again.
And how do we get that reclassification of Bitcoin that you're just mentioning?
I think it's something that happens over time, right? So we've seen little. So if you go back 5 years, it was a risk asset. There was nothing else about it, right? It was every uptick and downtick was with the stock market. Much more recently, we've seen a divergence in that. For instance, at this low, this is where the bank failures occurred, right? So we saw Bitcoin actually ripping higher when U.S. banks began to fail, and there was questions about deposits. That's really good to see. That tells you people are using it as a safety net. The other thing here was the BlackRock, this little low pivot, the BlackRock spot ETF caused this latest move. So I think you're starting to slowly see it morph, but it's a morphing that's going to take years, not weeks or months. And investors just have to be patient. Over time, as it becomes more and more accepted as a digital gold, then it will be treated as a digital gold.
Okay. And while we're on the tech side, I want to bring up AI, which I don't think we have had the chance to speak about yet. So there's been a whole craze around what's going on in AI. And I think a lot of people are wondering, how do they get exposure? And is now the time to do that? It gets even trickier because you have companies that are private, they're doing AI, or maybe a really big company has a small AI component. So I think it's very challenging to figure out what to do with this trend that we're seeing.
Yeah, it really is. And the biggest thing too is always liken it to past crazes, right? So you go back to the dot-com era, the late 90s. For those of you that are a little older, you may have experienced this, but the hype was much the same. Everyone said, "Hey, this is going to change the world," and they were right. The internet did change the world. Dot-coms did change the world, but there's this initial excitement, and then there's this kind of overbought scenario that has to unwind. You see the kind of the crap companies get flushed out. And we kind of saw this in crypto too. In fact, we're still seeing it where a lot of the altcoins are getting flushed out. The best will survive and thrive, much like a Bitcoin, maybe an Ethereum. But I think with AI, the same thing. So, for instance, an NVIDIA, to me, yes, it's amazing, but it's probably overdone for a while now and has to come back in. We'll see what the earnings obviously say. But, that would be the same thought process here is that I wouldn't personally, and I just speak from my perspective, is I'm not chasing these names to the upside. I'll wait for a flush out. Our emotion says chase because you can make a lot of money. Usually that's the opposite. We should be doing the opposite of that. So I think that's one of these scenarios, just like when Bitcoin was at 65, 69,000, we're like, oh, it's going to go to 100. And then it went straight down. Same thought process, use that same emotional kind of understanding.
Yeah, I think it's so tempting to jump in with the crowd, but as we know, usually that doesn't work out too well. And okay, then another, hopefully, maybe a bit of a fun question about AI. So, people, aside from wanting to invest, people are excited about how it can help them in their daily lives. And one of those facets is how can AI help you in investing? And I'm fully in the camp of this is not going to replace humans, but as a person who's out there educating investors, do you see a role for AI for people who are investing or trading?
Yeah, I mean, it's going to be interesting. I think as AI grows and becomes better and better, it'll be interesting to see do we end up with a fund that is run by AI? I mean, imagine that where a fund is making the decisions and being able to process things a million times faster than any of us can do. And so I do think there could be a disruption here. The question is it going to be good or bad? I mean, if we saw, flash crashes in the past in the stock market, they were driven by algorithms. And you have to wonder if, while it can be a very positive thing, there will be drawbacks and negatives. And us as humans have to be aware of those and kind of put the stop losses in so that that doesn't occur, where we don't get a stock market crash, for instance, on AI. But I certainly think that it will be beneficial. I've heard about financial advisors being replaced by AI now. It's coming. And I mean, it's a double-edged sword. It's going to be very good for productivity, but I think a lot of jobs are going to be lost as well. And I think that that's something that on an economic front, we're going to have to deal with as well.
Yeah, very interesting to kind of track these implications as it all moves forward. So that's everything I have for you today. But before I let you go, I did want to see if you had any final words for investors as we're heading into the fall.
Yeah, so I would just say this is that the overall M2 money supply continues to drop. M2 is basically the money in the system. So the Fed is drawing that out, raising interest rates. We know that kind of tightens liquidity. We see mortgage rates at ridiculous levels compared to where they were for the last 10 or 20 years. That's putting a big strain on housing, even though we're not seeing it in prices yet. I think that does create a scenario where housing could drop. And then you talk about inflation and the impact on investors. Investors now have $1 trillion in credit card debt. They've gone through all their COVID savings and now are running up. So there's a lot of, to me, dark clouds out there. I would just tell investors to be aware of that, make your decisions understanding that, and just to be careful overall.
Okay, I think that's a good place to wrap up. Thank you so much for coming on as always to talk about what's going on with the markets and all the various topics that we touched on.
Thank you so much. It was great to be here.
Of course, and once again, I'm Charlotte McLeod with investingnews.com, and this is Gareth Soloway with verifiedinvesting.com. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.